All right, the bear market continues. Whatever reprieve we had yesterday is over and done today. The relief that the Federal Reserve was going to get aggressive and try to get ahead of inflation, which agreed with a lot of buying yesterday, now being unwound by people reassessing that and saying, well, wait a minute, all these rate hikes to come, they're going to slow the economy down, maybe bring us a recession. Hence, you have the Dow, the S&P, and the NASDAQ swooning. In the case of the Dow, the only up players are Walmart and Procter & Gamble. But leaving them out of the picture, it's just down, down, down we go. In the case of the NASDAQ, 33% from its highs, let alone the Dow, about 1% or 2% from entering bear market territory itself. The S&P is there as well. All of this is playing out exactly as Peter Eliades said it would, the stock market cycles editor and publisher, kind enough to join us now. Peter, I remember catching an interview with you, I think you did last fall. Maybe it was right around Christmas time. And so those are heady days. The market was still looking pretty good, but you weren't buying it. Have you seen enough selling since that makes you think, all right, we've done enough?
Well, actually, it's interesting you asked that question, Neil, because I'm probably going to disappoint you and a lot of other viewers who view me as a perennial bear. Well, that guy's always bearish. And I mean, I think after interviewing
not all the
me
time.
for 20...
You're not all the time.
Yeah, thank you. I was going to say, I think after interviewing me for 25 or 30 years that I am not bearish all the time. I have been quite bearish, and I'm at a point, I'm at an ambivalent point now, because longer term, I am still very, very bearish. But shorter term, I think we're really close to a bottom here, Neil. I think that we're close. When I say a bottom, I want to emphasize the word a, because I think we're close to a bottom that could last for several weeks, if not a few months. We're not out of the woods by any means. I mean, this market longer term is going to go, in my opinion, significantly lower. But now, with everyone bearish and no apparent reason to be bullish, this is a great time to watch the market go up a bit.
So what are you seeing? First of all, what is your definition of short term? I mean, if this only goes on a little bit longer, then I want to get to, after that, the longer term. Let's go to the shorter term.
Okay, shorter term, I think within a week or two at the most, let's call it out to the end of the month, I think this down move will be over. That's shorter term. Numbers, I'll give you numbers. I'll give you very specific numbers. I don't think the Dow's going to close. If it closes near it, I don't think it'll close below around 29,005. I don't think the S&P will close much lower than 3630. And I don't think the NASDAQ composite will close much below 10,100. So as you can see, we're right near those numbers now, Neil. There's limited risk to the downside.
So what happens after that?
After that, we get ourselves a decent rally that will surprise a lot of people. We've got to drive some of these bears into the woods and say that, well, oh, wait a minute, maybe things aren't that bad after all. I think maybe, most of them will say once we start to rally, oh, thank God that's over with. Now we can get back to this bull market. Well, I wish we had time to discuss historically, Neil, where we are in the market in comparison to the last perhaps 50 or 100 years. This market has not been undervalued since 1982. Now, people can fire away reasons for me and tell me things have changed and technology has changed everything, and nothing has changed in terms of market psychology. That's what rules the markets, Neil, psychology. Right now, the psychology is very bearish. The Fed just made that large increase in interest rates, and everyone's saying, oh my gosh, nothing can save us now. And from that springs market rallies and hope starts to build again.
And so how long do you think that holds, this comeback or whatever you want to call it, short-lived though it might be? How long do you see that lasting?
I think there's a chance for it to last into the fall. The last time you and I spoke, I talked about the significance of Labor Day in overvalued markets. So Labor Day this year, we're talking about the beginning of September. I would not be surprised to see the market rally into that time zone, the beginning of September, maybe the middle of September, from which point, boy, I would get out of the way because I think we're set up for really bad things to happen on the downside. We're just
all right, when you say really bad on the downside, there are a lot of people who still look at the market at these levels, whacked as they are. It's still a rich market. I mean, about 15 times, we have S&P trading at 15 times forward earnings. So you could still say that's historically pretty high. So what are we in for come Labor Day or shortly thereafter?
Okay. I saw a very interesting article a few days ago, Neil. I was looking online, and they talked about 6 or 7 different valuation methodologies. You've heard of a lot of them: the Shiller Cape ratio, the Tobin's Q, the Buffett indicator. They put together those 7 valuation indicators, and let me emphasize that I have never used valuation indicators for market timing. That is a lost cause. But once you start down in earnest, as I believe we will do come the fall sometime, here's where they claim it would take a decline of this percentage to bring us back to the mean, not to undervaluation, but back to the mean of valuation. 52%, 58%, 68%, 63%. The average of these 7 valuation methods say that, and this was a year ago, so prices were a little bit higher, that we required a decline of 62% in the averages to bring us to the mean valuation level. Wow. So that's what we're looking at, Neil.
All right, that could be another roughly 30% on top of what we got at a minimum, right?
Oh, a lot more than that. I mean, we're down 33% in the NASDAQ 100, but the S&P's down in the low 20s. So
no, you're right. So there's going to be a world hurt. So what do you buy or what do you recommend in an environment like this? We've seen gold benefiting, we've seen agricultural commodities benefiting, but few and far between. There's really been no consistent safe haven. So what do you tell folks?
Yeah, well, I mean, I guess it sounds crazy, but how about cash and cash equivalents? I think interest rates are going to go up significantly. One of the problems that we faced here, Neil, is the Federal Reserve has been punitive to people in my age category. They've saved their whole lives thinking that, boy, when I get to be 65 or 70, I'm going to be able to sit back with a few $100,000, maybe even accumulate 500, 600, $1 million, and get those interest rates of 5, 6, 7% a year. I can live off that very comfortably. Well, good luck with that in current circumstances. We're talking about you're lucky if you get 1%, 2% in interest on a safe risk basis. So the Fed has forced people into making these decisions that brings them into the markets where they're going to get slaughtered. Where would I put the money now? I believe in diversification, but I also believe at this point, especially approaching the fall, Neil, and I think we're going to get ready for a real killer of a wave to the downside, there's nothing like good old cash or cash equivalents.
All right, but in an inflationary environment, you're losing money just keeping it in cash. But I guess your point is you'd be losing a hell of a lot more if you put it in the stock market. What could change that outlook as far as you see right now, Peter, where you think, all right, I overstated the potential of a fall tumble?
I don't visualize anything now, Neil, that could change it only because of where we stand in the valuation picture. I guess if we all of a sudden miraculously saw that inflation had come down significantly to levels of 2 and 3%, where it was a few years ago, you could argue that things aren't going to be as bad and people won't be as pressed in terms of their income. But I can't, suggest something to me that you think could prevent this from happening. I can't think of anything.
So nothing the Fed will do to try to get inflation under control is going to work, or certainly do anything to interrupt a recession that you definitely see coming.
You wrapped it up in a nutshell. I mean, I could go on and on about why and what other potential reasons are, but the fact is that The last time this market was undervalued, Neil, was in 1982. Now, again, you can argue all day long that, well, there are reasons for that. We shouldn't go to low valuation levels because there's a new technology going on, and we'll never see. It's a famous expression by the guy in 1929 that said, this market has reached levels that we will never go down again. I mean, there'll be no significant declines. And of course, that rings the bell loudly and clearly that, boy, you better get out of the way. There are a lot of people that kind of feel that way now. Yeah, we can see down 20, 30%, but the Fed won't let it fall any further than that. Well, how the hell are they going to avoid it? Have they been successful at that so far? Were they successful in avoiding that back in 2007, 2008? There's nothing the Federal Reserve can do. They've made enough mistakes as it is with these artificially low interest rates, which has caused a lot of the pain and overvaluation that we've seen.
Yeah, it just created this bubble atmosphere, to your point. Peter, I hope you're wrong on this, but you've been uncannily right about some major waves we have seen. We'll have to see how this plays out. One of the things I famously learned from you over the decades we've chatted, my friend, is this notion people glom onto that it's different this time. In the scheme of things, it's never different that particular time. You can move the date and everything, but it's never different. Peter, it's great seeing you again. Keep at it, my friend. People might not like what you had to say, but I think they respect the guy saying it. Peter Eliades, a very good read of these markets. I think 83 years young and still going strong and still thinking big. A little more after this.